98%. That is not a typo. That is not a bullish prediction. That is a documented delivery rate from the February 2026 COMEX silver contract. As of early February, 18.72 million ounces had been called for delivery from February open interest of 19.11 million ounces, a 98% delivery rate. Bar chart. In a normal futures market, that number sits between 5 and 20%. The people who stayed in the February silver contract did not roll forward. They did not take cash. They demanded metal, almost every single one of them, and now the March contract is live. March 27th is the last trading day. The delivery window is open right now, and the vault that has to satisfy whatever gets demanded has been draining at a rate that, if you run the arithmetic forward to March 27th, produces a number that this exchange has never faced in its modern history. I am going to give you 6 specific data points today. All of them are public. All of them are verifiable. All of them together tell you exactly what this market is facing between now and March 27th. And then I am going to give you the bear case, the argument that everything I just described is being misread because honest analysis requires both sides. Here is what I will not do. I will not tell you COMEX is definitely going to default. I will not tell you silver is going to $300 next week. What I will do is show you the documented data, show you the documented counter-argument, and let you apply the same logic to both sides that you would apply to any other data set. Let's build it from the ground up. Every number I give you today is public and verifiable. Links to all sources are in the description. Section 1. The 98% delivery rate, what it actually means and why it is the most important number in this analysis. Before I give you the March data, I need you to understand exactly what a 98% delivery rate means in the context of a futures market, because most people either dismiss the number or misunderstand it. Both errors are expensive. A normal futures market operates on an assumption. The assumption is that most participants do not actually want the physical commodity. They want price exposure. They want to hedge. They want to speculate. And so when a futures contract approaches delivery, the vast majority of participants roll their position forward to the next month or close it for cash. Historically in silver, between 80 and 95% of contracts never result in physical delivery. They roll or close. February is a minor delivery month. Participants who remain in the contract after first notice day are typically there because they actually want delivery. Yahoo Finance. The February 2026 delivery rate of 98% means this. 18.72 million ounces were called for delivery from February open interest of 19.11 million ounces. This is not a functioning futures market where contracts typically roll forward. This is a physical allocation mechanism. Bar chart, read that last sentence again. A physical allocation mechanism. The people holding February silver contracts were not trading paper. They were using the futures market as a purchasing system for real metal, and 98% of them followed through. The 5 through 36 contracts represent 5 to 8 times historical norms for February, confirming a behavioral regime change from paper speculation to physical acquisition. Latest lie. That phrase is the most important phrase in this entire video. Behavioral regime change, not a one-month anomaly. A documented shift in how market participants are using the COMEX silver futures system. And that shift did not start in February. Total COMEX silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces in 2025. Every single month in 2025 saw higher deliveries than the same month in 2024. One news page every month for 12 consecutive months. That is not a spike. That is a trend. And January 2026 was not the continuation of a trend. It was an acceleration. January 2026 delivered 49.4 million ounces, 4.17 times January 2025's level and 7.27 times January 2024. This occurred in a historically minor delivery month, indicating front-running behavior as market participants secured physical silver before March. One news page. 7.27 times. The January delivery volume was 7.27 times what it was 2 years earlier. In a historically minor delivery month, the people doing this are not retail stackers buying 1-ounce coins. These are institutional participants with the financial capacity to stand for delivery on COMEX silver contracts, each representing 5,000 ounces of metal. They front-ran March, they knew what was coming, and they wanted their metal before March arrived. Section 2. The vault. What the registered inventory actually shows right now. The 98% delivery rate is the behavioral data point. The vault numbers are the physical data point, and the two together produce a picture that this exchange has not faced in its modern history. COMEX registered inventory stood at 240 million ounces in April 2020. By February 2026, it had fallen to 86.13 million ounces, a decline of 153.87 million ounces, representing a 64.1% drawdown over 6 years. Substack. 64.1%, nearly two-thirds of COMEX registered silver has left the vault over 6 years, and the rate of departure has been accelerating. Registered silver dropped from 167 million ounces in October 2025 to approximately 103 million ounces by early February 2026, a 38% plunge in just months, accelerating recently with approximately 785,000 ounces draining daily. One news page, 785,000 ounces per day. That is the drainage rate this vault was running at heading into March. The withdrawal rate from these inventories is averaging 785,000 ounces per day. Substack. Now apply that number forward. From February 27th, the March 1st notice day, to March 27th, the last trading day, is 20 business days. At 785,000 ounces per day of underlying drain, that is 15.7 million ounces of additional depletion pressure on top of whatever March delivery demand is actively exercised. The vault that started March at approximately 86 million ounces is not a static number. It is a number with a daily leak of nearly 800,000 ounces built into it, regardless of what March delivery holders choose to do. Silver is showing significant demand and metal is leaving the vault at a rapid clip. This is a market in backwardation, facing high demand, record prices, and metal leaving the vault. Persistent contango and large registered inventory outflows signal robust physical demand. Silver's backwardation and rapid registered inventory depletion highlight acute spot market strain, raising the risk of physical supply stress if vault holdings fall below 50 million ounces. FX leaders 50 million ounces. That is the danger threshold identified in the analysis. The vault that was at 86 million ounces on first notice day, draining at 785,000 ounces per day, with 20 trading days left in the March window, is running toward that threshold in plain view. Critical observation. COMEX has delivered 86.4% of its current registered inventory in just 60 days, while maintaining sufficient inventory to cover demand. This represents the highest 2-month delivery rate in exchange history, occurring during a period when speculative positioning collapsed 77.72% year over year. Substack speculative positioning collapsed 77.72% year over year. This is the part that most mainstream analysis ignores entirely. The managed money category. The hedge funds, the speculators, the momentum traders who drive price in normal markets has been flushed. Managed money contracts 54,415 in February 2025 versus 12,121 in February 2026. Latest LY. The speculative long base that would normally be rolling contracts forward is gone. The participants who remain are the ones who want delivery, and 98% of February's remaining participants proved exactly that. Section 3. The March number. What 52.63 million ounces means against 86 million ounces available. Now let me give you the specific March delivery data because this is the number that translates the 98% February rate into a real-time March problem. On the first notice day for the March contract, delivery notices were issued for 10,526 contracts, representing roughly 52.63 million ounces of silver. This delivery demand represents more than 60% of the total registered inventory, leaving a dangerously small margin for error. Financial content, 10,526 contracts. 52.63 million ounces demanded on day 1 against 86.13 million ounces registered. That leaves approximately 33.5 million ounces of registered silver that was not immediately claimed on first notice day, 33.5 million ounces of buffer against a vault draining at 785,000 ounces per day, against 20 remaining trading days, against whatever additional delivery notices get issued between now and March 27th. By the end of February 2026, registered silver stocks fell to approximately 86.1 million ounces, a sharp 31% decline from levels seen only months prior. Financial content. And here is what makes the March number structurally different from every prior delivery season. For March 2026, open interest in the March silver contract represents approximately 500 to 528 million ounces notional. If only 10 to 25% of participants stand for delivery, a conservative assumption during stress, March faces delivery requests of 70 to 90 million ounces. Intellectia Dei. The 10,526 contracts on first notice day was not the total March delivery demand. It was the opening bid. The March contract window runs until March 27th. Holders can issue delivery notices throughout the delivery period. The 52.63 million ounces is what was demanded on day 1. It is not what will be demanded by the last day. Silver closed at $90.10 per ounce on first notice day, up 2.07%, as investors sought safe haven assets amid geopolitical tensions and trade policy uncertainties. The rally coincides with CME data showing 10,526 contracts standing for March delivery against 86.13 million ounces registered. Latest lie. The market knew the number when it was published, and it bought on the most technically significant delivery day of the March contract, when the exchange was simultaneously managing a post-halt recovery and a geopolitical war premium. The price went up 2.07%. The people who understand COMEX mechanics saw the 10,526 contracts and bought, not sold, bought. Section 4, the 2-month acceleration. Why January and February together tell the real story. I want to give you the complete 2-month picture because January and February together reveal something that either month alone obscures. January 2026 delivered 49.4 million ounces. February 2026 delivered 25.18 million ounces, the highest February delivery volume in modern COMEX history. Combined, January and February 2026 delivered 74.58 million ounces. COMEX has delivered 86.4% of its current registered inventory in just 60 days. Latest lie, 86.4% of the vault's current registered inventory was delivered in 60 days, in 2 months that are both historically minor delivery months. January and February are not March. They are warm-up months. They are the months when the exchange typically moves 3 to 8 million ounces combined. Typical February deliveries, 3 to 5 million ounces, representing 600 to 1,000 contracts. The 5,036 contracts represent 5 to 8 times historical norms. Latest lie, 5 to 8 times in a minor month. And the behavioral explanation for why this happened is now documented in the data. In January 2026, which is not a major delivery month, COMEX processed delivery demand totaling between 33 and 40 million ounces through the first 2 weeks, with estimates reaching as high as 49 million ounces for the full month. December 2025 saw 46.635 million ounces delivered, representing 50% of the estimated free float. The January 2026 figure represents a 7 to 10 times increase over historical January averages. This is not profit-taking, this is front-running. Market participants accelerated their delivery requests before March arrived. Intellectia.ai. Front-running. That is the documented interpretation of the January and February delivery surge. Institutional participants who understood the March setup were securing physical metal before the March delivery window opened. They saw the same math you are seeing right now. They acted on it in advance. And the vault drain that resulted from their advance action reduced the inventory available to March delivery holders by tens of millions of ounces before the March 1st notice day even arrived. Simultaneous with January's delivery surge, COMEX silver flowed to London at an extraordinary pace. During the first week of January alone, COMEX registered inventory declined by 18 million ounces, while deliveries totaled 33.45 million ounces, meaning the balance was sourced from already allocated inventory or eligible stock conversions. London lease rates spiked to 34.9% on October 9, 2025, with intraday peaks reaching 39.2%. Intellectia.ai. The London connection matters for one specific reason. Silver that flows from COMEX to London to cover the LBMA's own delivery stress cannot also cover March COMEX delivery demand. Metal that left the vault in January to address London's 34.9% lease rate emergency is not sitting in a COMEX warehouse waiting for March delivery notices. It is in London. It is not coming back without price incentives significantly above current levels. Section 5. The China factor. Why the arbitrage that used to replenish this vault no longer works. Here is the structural context that makes the 2026 delivery season categorically different from every prior year. And this context did not exist in any historical precedent the bears are using to dismiss the bull case. The implementation of strict export controls on refined silver by China on January 1, 2026, has severed traditional arbitrage routes. This has led to a persistent premium of $8 to $13 per ounce on the Shanghai Gold Exchange compared to New York prices, drawing physical metal away from Western vaults toward Asian hubs. Financial content, $8 to $13 per ounce. That is the Shanghai premium above Western spot. In a normally functioning global silver market, that premium would be arbitraged away within days. Traders would buy silver in New York, ship it to Shanghai, collect the premium, and the price differential would close. That arbitrage mechanism is what historically prevented persistent regional shortages. It replenished vaults that were draining by pulling metal from wherever it was cheapest. China refines 70% of the world's silver. China implemented export controls on January 1st. The arbitrage that would pull refined silver from Chinese refineries to fill draining COMEX vaults is now blocked by regulatory action from the government that controls the world's dominant refining capacity. As of January 1, 2026, China, which refines 70% of global silver, added silver to its export control protocols, making it harder to obtain the metal. CME Group. The vault drain mechanism exists. The replenishment mechanism that historically offset vault drains has been severed by a government policy decision made on January 1, 2026. These two facts together, drain active, replenishment blocked, are why the 2026 delivery season is not comparable to any prior year in COMEX's modern history. Shanghai's silver inventory is critically low at 318 metric tons, and a billionaire trader has a 450 metric ton naked short position against this inventory, potentially setting up a short squeeze. CME Group. The same physical shortage that is draining COMEX vaults is simultaneously visible in Shanghai. Both major global silver exchanges are showing acute physical stress simultaneously. That is not a COMEX-specific phenomenon. It is a global physical silver market phenomenon that happens to be most visible in the COMEX registered inventory numbers because those are published daily. Section 6, what March 27th actually means. The calendar that nobody is explaining clearly. Let me give you the specific March delivery calendar because the dates are where this abstract analysis becomes concrete and time-sensitive. February 27th, 2026 was the March 1st notice day. The first day when March contract holders could be required to take physical delivery. 10,526 contracts, 52.63 million ounces, stood for delivery on that day. March 27th, 2026 is the last trading day for the March silver futures contract. That is the hard deadline. After March 27th, the March contract no longer exists. Holders who have not closed, rolled, or stood for delivery by that date face automatic settlement procedures. Between February 27th and March 27th is a 20 trading day window. In that window, every holder of a March-long contract makes a decision: roll to May, take cash, or stand for physical delivery and join the 10,526 contracts already in the delivery queue. May contract cycles traditionally serve as secondary delivery opportunities for participants unable to secure March positions. If March experiences delivery stress, demand concentration shifts toward May contracts, potentially creating sequential default scenarios. July contracts represent the final opportunity for industrial users requiring summer manufacturing inventory, creating cascading pressure if earlier delivery periods fail to provide adequate physical supply. Financial content. March 27th is not just the end of the March contract, it is the beginning of the May contract stress test. Every March holder who rolls forward rather than standing for delivery adds to May's open interest. And May's open interest is already building with position transfers from March. A total of 3,589 new contracts opened in May when 2,943 contracts rolled from March. Roughly 18 million ounces shifted to May. Latest LY. The March 27th deadline does not resolve the underlying supply tension. It transfers it. The vault that exits March with whatever registered inventory remains becomes the starting point for the May delivery season, and the drain rate that carried the vault from 167 million ounces in October to 86 million ounces in February does not stop on March 27th. Section 7, the bear case, why the 98% number may be overstated, and what the exchange's actual tools are. I always give you both sides. The bear case on the March delivery crisis is serious, well-constructed, and you need to hold it alongside everything I just showed you. One of the loudest claims fueling default fears is that February saw a 98% delivery rate. The 98% figure was based on a denominator error, dividing total deliveries by a single snapshot of open interest. Open interest is dynamic and constantly changing, so that calculation overstates the true delivery percentage. Yahoo Finance. That is a legitimate methodological critique. Open interest in the February contract was not a static 19.11 million ounces throughout the entire month. It was declining daily as contracts were closed and rolled. Dividing total monthly deliveries by a single early month open interest snapshot produces a delivery rate percentage that is higher than what a more precise calculation would show. The 98% figure is the most widely circulated version of the February delivery data. The bear case says the denominator is wrong, and the true delivery rate, while historically high, is lower than 98%. When delivery occurs on the COMEX, physical silver does not typically move. A delivery is a transfer of a warehouse receipt, essentially a warrant of ownership. The silver stays in the vault unless the new owner decides to withdraw it. That same warrant can change hands multiple times without a single ounce leaving the warehouse. So when you hear that deliveries are surging, it doesn't mean silver is vanishing from COMEX vaults. It means ownership is changing, not location. Yahoo Finance. This is the most important bear case argument, and it is factually accurate. A COMEX delivery is not necessarily a physical removal. The warrant transfers, but the bar stays in the vault unless the new warrant holder specifically requests withdrawal and arranges transport. Silver is showing significant demand, and metal is leaving the vault at a rapid clip. FX leaders. The Seeking Alpha analysis does show metal leaving the vault, not just changing ownership. but the distinction between warrant transfer and physical removal matters for assessing how quickly the vault actually drains. The conversion process from eligible to registered status typically takes 24 to 48 hours, meaning the effective delivery capacity exceeds the registered figure that generates default headlines. Market analysts frequently extrapolate February delivery patterns to predict March outcomes, despite fundamental differences between minor and major contract months. Financial content. The eligible category, silver stored in COMEX-approved vaults but not yet formally pledged to delivery, provides a conversion buffer. If registered inventory falls critically low, eligible owners can convert their metal to registered status in 24 to 48 hours, temporarily expanding the deliverable pool. The total COMEX inventory, including eligible, is approximately 366 million ounces. The registered-only number of 86 million ounces does not capture the full picture of metal available in COMEX-approved facilities. The COMEX maintains extensive authority to modify contract terms and settlement procedures during market stress, providing multiple intervention mechanisms. Similar mechanisms apply to silver futures through contract specification amendments for force majeure conditions, delivery period extensions when warehouse logistics become constrained, settlement price adjustments reflecting physical market premiums, and emergency trading procedures, including position liquidation authority. Financial content. The exchange has tools: margin hikes, cash settlement substitution, force majeure declarations, delivery period extensions. The LME used these tools in nickel in March 2022. COMEX used a version of these tools during the Hunt Brothers squeeze in 1980 when it switched to liquidation-only mode. The bear case is not that the vault is infinite. The bear case is that before the vault runs out, the exchange has enough institutional tools to prevent a formal default. The paper price might fall. Delivery demand might be managed through margin pressure, but the exchange itself does not cease to function. The honest assessment of the bear case is this: it is not wrong about the mechanics. Warrant transfers are not physical removals. Eligible inventory provides a buffer. The exchange has emergency tools. March is different from February. All of those arguments are defensible. What the bear case cannot fully address is the 785,000 ounce daily drain rate, the China export control severance of the replenishment mechanism, the documented behavioral regime change in delivery rates, and the 64.1% 6-year registered inventory decline. Those structural facts do not disappear because the exchange has emergency tools. Section 8. The 3 scenarios for March 27th. What actually happens on the last trading day. Let me give you the 3 realistic scenarios for how this delivery window closes on March 27th. Scenario 1. Managed delivery completion. Most likely scenario: the March delivery demand gets satisfied through a combination of registered inventory draws, eligible to registered conversions, and a modest percentage of longs choosing to roll to May rather than stand. The vault exits March with somewhere between 40 and 65 million ounces of registered silver remaining. No formal default, no force majeure announcement. The physical stress is visible in the inventory reports and lease rates, but does not force a public crisis event. Silver trades in the $88 to $100 range as delivery pressure sustains physical demand against paper short pressure. The May contract inherits the stress at lower inventory levels. Scenario 2. Partial delivery squeeze. Possible scenario: delivery demand between now and March 27th builds beyond the 52.63 million ounces already claimed on first notice day. The vault approaches 50 million ounces of registered inventory in the final week of the delivery window. CME raises margins again, potentially the 7th or 8th hike in this cycle, to force additional rolling. Some delivery holders accept cash premiums above spot rather than waiting for physical delivery that is taking longer than expected. The premium offered above spot to induce cash settlement becomes visible in the market data. Silver tests the $95 to $105 range before the March 27th close, as the cash settlement premium inflates the paper price temporarily. Scenario 3. Force majeure declaration. Less likely but documented as a possibility by COMEX's own rulebook. Delivery demand in the final week of March exceeds available registered plus rapidly convertible eligible inventory. CME invokes Rule 701 or alternative delivery procedures. The exchange announces a delivery period extension or mandates cash settlement for some portion of outstanding delivery notices. This is the LME nickel precedent applied to silver. The price action in this scenario is the most violent and the least predictable because force majeure declarations destroy the assumptions that every model in the market is built on. This scenario does not require the entire 52.63 million ounces to be unfulfillable. It requires only that the pace of delivery notice issuance between now and March 27th exceeds the pace at which the exchange can source and transfer registered metal. Section 9. What to watch. All free, all public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on a paid service, it is not me. You find me here on YouTube and on X, where data breaks when it happens. Here is your specific watch list between now and March 27th. Every item is free and public. CME Daily Delivery Reports, published every afternoon at cmegroup.com. The most important number is the cumulative March delivery total building toward March 27th. Watch whether the pace of new delivery notices accelerates in the final week as the deadline approaches. Link in description. COMEX registered silver inventory. Updated daily at the CME warehouse stocks page. The number to watch is whether registered inventory falls below 50 million ounces before March 27th. Seeking Alpha identified that level as the threshold where physical supply stress risk becomes acute. At the current daily drain rate of 785,000 ounces, the math to that threshold is straightforward arithmetic. Pull the number daily. Eligible to registered conversion volume. Watch whether the eligible category starts declining sharply while registered stays flat or declines more slowly. If eligible owners are rapidly converting metal to registered status, it means the vault managers are drawing on the conversion buffer to meet delivery demand. That signal tells you the registered number alone is understating the real delivery pressure. CME margin announcements. These come on Sunday evenings and take effect Monday morning. Every prior margin hike in this cycle, and there have been 6, was announced on a Sunday night. If CME raises margins again before March 27th, it is the exchange using its institutional tool to reduce delivery demand by forcing marginal longs out of their positions. The timing and size of any further margin hike tells you whether the exchange is managing a routine situation or an acute one. Shanghai Premium, currently $8 to $13 above Western Spot. Watch whether this widens further as March 27th approaches. A widening Shanghai Premium while COMEX registered inventory falls tells you that the global arbitrage mechanism that would normally replenish the vault remains fully blocked. A narrowing premium would suggest China's export controls are being selectively relaxed, which would be a material change in the physical supply picture. Silver lease rates. London lease rates at 34.9% versus historical normal of 0.3 to 0.5%, 70 times normal. Watch whether this falls toward 10 to 15% before March 27th, which would signal physical stress relief, or rises above 40%, which would signal the acute shortage is intensifying into the final delivery week. Section 10, the honest conclusion. Here is the full picture as of Saturday morning, March 7th, 2026. 20 trading days before the March contract last trading day. February 2026 delivery rate, 98%. A 98% delivery rate means this is not a functioning futures market where contracts typically roll forward. This is a physical allocation mechanism. Bar chart. February 2026 delivered 25.18 million ounces, the highest February delivery volume in modern COMEX history. Combine January and February 2026 deliveries, 74.58 million ounces. COMEX has delivered 86.4% of its current registered inventory in just 60 days. Latest LOI March, first notice day, 10,526 contracts, 52.63 million ounces, standing for delivery against 86.13 million ounces registered. Delivery demand represents more than 60% of total registered inventory. Financial content COMEX registered inventory decline 240 million ounces in April 2020 to 86.13 million ounces in February 2026, a 64.1% drawdown over 6 years. Substack. Daily drainage rate, 785,000 ounces per day. Substack 20 trading days remaining. 15.7 million additional ounces of drain pressure before March 27th at current rates, before counting additional delivery notices. China export controls implemented January 1st, 2026, severing traditional arbitrage routes and creating a persistent $8 to $13 per ounce Shanghai Premium above Western Spot. Financial content. The exchange has tools to prevent a formal default. The bear case on those tools is coherent and you should hold it, but the bear case tools, margin hikes, eligible conversion, cash settlement, all have costs. Margin hikes force the violent price crashes from $121 to $64 and from $91 to $82 that have defined this market over the past 6 weeks. Cash settlement above spot is an admission that physical metal is scarcer than the paper price implies. Eligible conversion is a finite buffer that depletes with each use. March 27th is not the end of this story. It is a data point in a longer structural story about what happens when the behavioral regime of a futures market shifts from speculation to physical allocation. That shift is documented. It is in the CME's own delivery reports. And it did not happen in March 2026. It started in January 2025 and has been accelerating for 14 months. The data will tell you what happens next. Your job is to pull it every day between now and March 27th and let the numbers build the picture without the narrative telling you what to see first. Invest with logic, not hype. Protect your capital. The 98% number is real. The 64.1% vault decline is real. And March 27th is 20 trading days away. Drop March 27. Watch in the comments if you are tracking the CME delivery reports alongside the registered inventory through the final week of this delivery window.